Malcolm, how you doing?
I'm good, man. It's Halloween season. And for whatever that means for you, it means turning off all the lights in my house and pretending not to be home. But you know,
Oh, that's
the,
that's kind of grinchy. I feel like you would be a big Halloween guy.
only when it comes time to walking around the neighborhood with my kid. I like
Okay.
seeing how excited she is about Halloween, but I personally could care less.
That's fair. I was like, if you're also turning all the lights off and your kid's not celebrating Halloween, maybe there's like a spiritual reason you're not doing that. So I didn't want to harp on that because I know people have that going on. But come on, that's one of the most fun days of childhood. Yeah.
Yes, I have a conscientious objection to candy.
Okay, fair enough. I am in the stage of life where I'm trying to quickly put together a costume because it's
Hmm.
something I put off so I can go to a party where people are like maybe drinking jello shots and complaining about their jobs and dating life, so I can
Yep.
look like I have a costume, but I don't want to be one, like I'm not one of those people who is putting an extreme amount of time and attention into their Halloween costume where I'm
You're
starting to
the
think about it in
the Jim
August.
Halpert from The Office. You're that guy.
Three-hole gym, there you go.
Yeah, there you go.
All right, today I think we've got some big tech stuff to talk about with big tech earnings. Very quiet sort of LLM that has been launched from
Hmm.
China that is not making the same amount of news as DeepSeek that I think is really interesting. You've got some thoughts on OpenAI, and then our big story in the second half of the show is the wave of tech layoffs. And we're going to approach this from a little bit of a different angle because it's not just why it's happening, but also some of the personal finance and I would say mental health elements that go into this type of story that I don't see a lot of coverage over, and I want to make sure we spend a lot of time on. So, Malcolm, one number I want to reflect on as we start the show
Okay.
is that Nvidia over 5 trading days, and this is previous week, added about $645 billion worth of market cap over 5 days. That is more than the entire S&P 500 to 18. It's more than Netflix, more than Netflix and MasterCard. There we go. More than Netflix and MasterCard. And I remember a year ago, a little over a year ago, I Nvidia went up like 14% in a trading session. It
Hmm.
was more than a whole McDonald's in market cap. And I'm like, market's a little overexcited right now. I was totally wrong. But, any reflections on Nvidia adding that much money in market cap over about a week and it just being a part of a normal course of business in the stock market right now?
Two things. One, I am a very firm believer in that's just how important Nvidia is to our lives today. I wasn't there 2 years ago. I have come around. I'm sort of late to the party in accepting that. I'm also late to the party in accepting just how important Jensen Huang sees himself in his role in helping to shape the future of the world. And he takes that role and responsibility extremely seriously, I'm learning. And so it's not surprising to me that Nvidia would be able to generate that much market cap in a week, basically, simply because of how money functions, right? Anytime you have a ETF that has to have a certain weighting of Nvidia, well, got to buy more shares. Anytime you have a fund manager who looks up one day and recognizes they're underweight Nvidia and that is what's driving the rest of the market, well, got to buy more shares. And so over and over and over, just as a function of how our financial system works now and how money flows through the stock market, Nvidia is just going to keep getting bigger and bigger for the sake of its bigness because it's so big that it has to keep getting big. So no, that doesn't surprise me at all.
That you just described a bubble, right? Something has to keep
I
getting
am
bigger
on
and
record
bigger
as
for the
I'm on
sake of
record
its
as
bigness.
confirming that
Yeah.
I agree that this whole thing we're living through right now, we're watching a bubble
Yeah.
not even being formed. It's already formed. We're watching it blow and blow and blow. The thing is, I just don't think that it's anywhere close to reaching its max capacity yet. I think we still have another year or two before the bubble finally says, I can't take this anymore. I got to pop.
And that's been reflected in some of the earnings, especially we saw from Amazon, right? Like there's still a lot of money coming into big big compute, let's call it that. But the thing that was surprising to me about sort of this growth over this week, and we like to focus on the long term, but life happens in
Hmm.
short term increments, is that This growth happened at the same time that a Chinese startup, stop me if you've heard this one before, a Chinese startup called Minimax launched a language model. And the team, this is backed by Alibaba, and the team claims that it can generate tokens almost as good as Claude at about 8% of the cost. Also, it runs twice as fast. How are they able to do that? It's a good question. But it's open weight, and it means that anyone can adapt it and run it on their own hardware. I checked it out. It's pretty good, Malcolm.
I hope you didn't use your actual email address to sign up for this.
So here's the thing. I used a burner.
Okay.
However, I still did it on my computer, and also I have I realized I have a CapCut, which is video editing software that's sponsored by TikTok and ByteDance on my computer.
Oh, so you're just asking for it.
If they're in, they're in. On this specific story, Malcolm, why I guess I can't make sense of this, because last time DeepSeek did this, there was a huge sort of correction, and now nobody cares.
Well, I think DeepSeek front ran this announcement in the sense that there was skepticism immediately, myself included, that said, I don't know that I trust that. It sounds way too good to be true. It's coming from China, which in a lot of cases we've been taught that when the Chinese government tells us something about a technological breakthrough, we should approach it with a healthy level of skepticism. So on one side, the math ain't mathin'. On the other side, it's coming from the Chinese government. Do with that what you will. And so I think in this case, we're looking at this announcement and saying, yeah, we hear you. We can look under the hood and we can find out if there's some there. But until the information writes a story about how, hey guys, no, there's something actually to look at over here, I think the market is safe.
So I played with it. I watched some demos of people who really know what they're doing. Malcolm, it's pretty good.
Yeah, but the question is, was
slick.
it actually created for 8% of the cost? That's the part that we don't actually know yet.
So no, it's the question is, can it run at 8% of the cost with significantly more efficiency than these Claude models? Because there's sort of this catch-22 going on, right? Like OpenAI and Claude, they are sucking up data all across the internet to make their models better. But then when it comes to our models are very much our intellectual property or our intellectual property, and you better not copy any of that code to make yours better. Yeah. And we're going to protect that as much as we can. So
even though we scraped all of your data to create the programming inputs that made these LLMs what they are.
Exactly. And I want to shout out Alex Smith for sharing the story with me, because in the other side of this though is, yes, there is hesitancy toward the data that any startup from China puts out, but there's also this arms race going on between the LLMs that are being built in the United States and in China. And it's this sort of Cold War of who can build the digital god first, right? And there are examples, if this is true, that these models can run it, significantly more efficiently than what we have right now. A lot of the data center build out may be an oversupply. And
let's say for a second this Minimax story isn't the dam that breaks, but it is something similar. I do think that the biggest risk right now to the Nvidia story I just got done telling, right, the excitement over Nvidia, is the idea that someone like Amazon, for example, who's decided we're not going to buy $40,000 GPUs, we're going to go it alone with our Trainium models. If Amazon can figure out a way to get the same level of compute on the AWS platform using their own homegrown Trainium models for less cost than anything run on an Nvidia GPU, then oh my goodness, that is the end of this overbuilding using solely Nvidia's GPUs. And then you got to factor in all the companies that are basically built to buy GPUs from Nvidia and then lease them out. CoreWeave is an example, right? So I do think there's something to be paying attention to, just to get an idea of how close we are to that becoming a reality. But again, I don't know that I can trust this particular this Minimax story as the thing that's going to be that straw.
I agree. I think it is a step in a story. And there's also, I started reading a book called Narrative Economics by Robert Shiller. And this is something that we do and everyone in the market tries to do, which is, just make sense of the logically ordered sequence of events about what is coming next. And one of the stories that he tells in the book is the roller bag, the roller suitcase. And that actually only became popular in the 90s, despite people trying to say, hey, wouldn't it be a lot easier if you put your luggage on wheels in the mid 20th century and maybe even the 1800s, right? And what it took was a smart branding person to give it out to airline pilots. So when people were traveling, it didn't look goofy. You see these slick airline pilots, effortlessly rolling their bags, and people go, oh yeah, that looks good. I want to do that too. And his point was like, you can't, just because you have a good idea doesn't mean it will immediately, take off the way people think. Usually there's something else going on. I think this is true with AI as well. And as we sort of move on to the next story, I thought this passage is especially relevant to what we're talking about. Quote, history, including economic history, is not the logically ordered sequence of events that it is presented by subsequent narratives that try to make sense of it or try to achieve public consensus. Most things happen because of seemingly irrelevant mutations in narratives that have slightly higher contagion rates, slightly lower forgetting rates, or first mover effects. So what we're seeing with these AI stories, some things become a contagion, some things don't, and it's hard to tell why. You want to go to OpenAI and Microsoft? Because I know you got some thoughts.
Just a couple of days ago, the announcement that we saw come across the ticker tape, as it were, was the announcement that Microsoft and OpenAI finally got done with couples counseling and settled on an agreement for how they're going to restructure their relationship. And so Microsoft basically gets a 27% stake versus the 49% stake they initially had. But there's a ton of other goodies in there on the Microsoft side, which I'll start with, because basically they now get another $250 billion worth of Azure cloud revenue committed from OpenAI. I don't remember what the timeline for that is, but it's $250 billion of additional cloud revenue that they can put on the books as outstanding performance work to be done, right? So that's one piece of it. But then separately from that 27% stake based on OpenAI's recent internal tender offer they did to buy shares off their employees, that puts that stake at $135 billion that now sits on Microsoft's balance sheet. So that's not nothing, right?
That's
and
certainly
then
not nothing.
Whenever OpenAI does finally figure out how to turn itself into a profit engine, well, 27% of that is coming back to the house. So for Microsoft, this is a huge deal. And they still keep the first right of refusal on any future deals that OpenAI wants to expand with. They also get to participate in using OpenAI's future technologies. And so it's still a great deal for Microsoft. They just own less of a stake than they used to. Okay. But another really important piece of the story, OpenAI needed to turn itself into a for-profit company before the end of the year to the tune of $22.5 billion is what was at stake, right? So Masayoshi Son made an offer to invest in OpenAI, and a portion of it, the lion's share of it, was contingent on them being able to turn themselves into a for-profit company instead of a nonprofit. And so that part also was a really big deal. Now I'm bearing the lead here. The thing that really matters in all of this story is that clears the way for OpenAI to finally go public. Mm-hmm. So I just told you somewhere around $500 billion is where they just were valued at when they'd had the tender offer earlier this year. It's estimated that this company may go out on the market at $1 trillion valuation.
All right, I got a splashy question.
$1 trillion IPO with a T.
Is this a $1 trillion SPAC, Malcolm?
This is not $1 trillion SPAC. This is a company that actually does some work. This is a company that won't even be able to use a SPAC to go public because there will be so much scrutiny in all of its filing documents that would I want to say never, but in this America, who knows? But it's unlikely that would actually fly. But then separately from that, they're expecting to spend $1.4 trillion on infrastructure for AI. That's OpenAI. That's their reported, expected spend. However, if they go out at $1 trillion, that's going to raise $60 billion for them in the IPO.
Which is a little bit less than the 1.4 trillion
that
they
is
need
significantly less than what they're committed to spending. And so the question becomes, where's the rest of the money going to come from? Because that number, even though it's large for any other company that would take itself public, because Sam Altman has made himself and this company so important to the AI revolution, $60 billion isn't going to cut it. And so then you have to worry about additional shares being issued the next morning, and you have to worry about bonds starting to be issued the next morning after that. And that, my friend, is where we start to ask questions about this bubble and when it might burst.
Well, and the other piece of this too is you can say you need to do $1.4 trillion in infrastructure for AI. How do you get the power for that? Or
the 100 gigawatts of power that he's committed to with all these different deals that have been announced in the last 2 months.
Knowing everything you know now, IPO goes out tomorrow. There's not a big pop, which we know that there's going to be a big pop.
Oh my
crash,
God, yes.
Right? Would you go out and get some, given what you said about Nvidia, you were late to the party. You still think that this is a long-term bubble. Would you be excited about owning some OpenAI as a retail? You're not a retail investor because you're a financial advisor, but if you were a retail investor, would you be excited about owning OpenAI in your personal account?
No.
Okay.
I would be excited about the fact that it's in the S&P 500 and it's going to lift the S&P and the NASDAQ for however long it does. But I wouldn't personally say I have to add shares of this company. Yeah. The reason I say that, though, is not anything fundamental about OpenAI as a company. I do think it's like one of those transformative companies that's going to change the way we think about and do everything, similar to Amazon. But I think the reason that this one isn't attractive to me is because how do I know the juice hasn't already been squeezed? Yeah. Like the fact that it was able to stay private long enough to cultivate a $500 million valuation. Sorry, $500 billion valuation, and then come out to the public markets at $1 trillion. Like, where is their opportunity for me? I want to be invested in the company that's like a $5 billion valuation at the moment that it comes out and work its way up to a $500 billion valuation. Like, let me participate that way. I don't want you to squeeze all the juice and then give me the rind.
Well, and this is maybe a dumb take, but one of the problems I have with this is that trillion just sounds like a made up number. like trillion, billion, whatever. I want to go on with big tech earnings. The one thing that I was looking at this week, and it's because I'm a shareholder of Meta, is how much Meta got beat up on a tax issue that seemingly no one understands. My response is pretty simple. There was something they did with asset adjustments due to the big beautiful bill. Do I think the big beautiful bill will end up hurting or helping Meta's tax situation? Probably helping. If you look at the income from operations, it still looks really good. I'm happy to be a shareholder. For as much as we talk about bubbles and AI buildouts, like it's still a pretty good idea to invest in, regulated or maybe even unregulated monopolies for decades. And the number that really stood out to me is that Zuckerberg highlighted is that there was 5% more time spent on Facebook in Q3 of this year. 5%, which sounds like a little, but for a company that already has more than half of the world's attention every single day, that is an incredible amount of time that this social media app is still able to just suck out of human existence every day.
Well, that might also be people leaving one platform and migrating back to another. And I don't mean in terms of like shutting down your TikTok account or your YouTube account, but there's something about it that you find less entertaining than you now do Instagram or Facebook. And so you're just opening that app first instead of the others that you usually would, reflexively open up as soon as you, swipe your phone up.
And I think part of this too, Facebook also has these longer reels where all of it's like time spent on the app. And, a lot of Facebook posts were like quick reads or short videos. And now there's like 1 to 5 minute reels that are being played more. Sometimes when I'm having mindless dopamine time on the couch, I've caught myself where I'm like, oh, I've spent more time on this than I thought I was. Greatest hypnotist in the world, Mark Zuckerberg. Anyway, I want to go to the big story now, unless there's anything else on big tech earnings you want to chat about, or you ready for the big story?
I will just say, as an investor and a person who watches big tech specifically as closely as I do, I'm actually glad to see such a mixed bag of earnings. Like, I appreciate that it's showing that Wall Street's not asleep at the wheel and just sort of autopiloting this thing. and there's actually trades being placed. There's actually bets being made in one direction or the other based on what's actually in those earnings reports versus just, the default setting.
Yeah. Big story, and this is the tech layoffs that we're seeing in the headlines. Amazon is the big one. They've done 14,000 so far. There's many people believe that it will be significantly more than that. Target cutting 1,800 corporate jobs, UPS cutting some corporate jobs, but also a lot of drivers and warehouse workers, which is significant if you're looking for economic indicators. But I think these headlines in context, something that's interesting to me is that layoffs.fyi that tracks specifically tech layoffs are showing about 113 so far in 2025. And I'm not going to do the math, but you can check me on it. This is actually lower than what's tracking for the total of 2024. So as we go into this, these are incredibly painful, and AI is certainly a part of this story. But something that's been unexpected to me, Malcolm, is I would have thought that as these AI tools get better and stronger, you would see more white-collar tech layoffs. Maybe it's a lumpy distribution, but that's not necessarily proving to be the case in 2025.
Yeah, I think that to me, what's happening with AI, I know folks want it to be binary on one side or the other. Either it's taking jobs or it's not. It's replacing humans or it's not. But I think it's such a mixed bag because if you just think about, when you're walking through the woods and you hear a loud snap, most people's first reaction is you would freeze. Then you figure out whether it's fight or flight time. And I think that's what's happening inside of these companies is it's not necessarily the knee-jerk reaction, oh my God, we got to cut headcount, or no big deal, we can just keep things as they are. Everybody's reaction has been to just kind of pause, see what is actually happening out there, and then start to move from there. And so I think that the layoff count that you're referring to that seems kind of low in comparison to what we were seeing in like 2022 when companies were saying, oh, we overhired by a long shot and we needed now to make these cuts. I think that what we're going to see next year potentially is the companies that have stood still, assessed the situation, and then decided, oh yeah, we definitely have way more people than we actually need to do these jobs. And that's where the flood starts to come. But Amazon as a company has already shown itself as being a group that doesn't necessarily care about public opinion. And so for them to feel like maybe we made the choice to cut a little early, but we're okay with that, that seems to be their MO. They tend to lead with these massive layoff headlines and then everyone else follows.
And Amazon was also saying, hey, yeah, we were very serious about you coming into the office 5 times a week. I think some of that is not even messaging, but just we are an in-person culture. And that's, if you want to work here, that's a part of it. But what's different about Amazon compared to some of the other companies, when you look at Target, for example, or for some reason, Chegg gets lumped in with a lot of these stories because it's an AI story, but it is so tiny compared to Amazon. And yeah. I'm not trying to dismiss the pain of any layoff, but it's just the immediate comparison. There is simply more. But with Amazon, it's so odd because this company is doing so well. Layoffs, you think, happen when a company is struggling and they need to cut costs. And yet you see HR exec Beth Galetti saying that, quote, we're convinced that we need to be organized more leanly with fewer layers and more ownership to move as quickly as possible for our customers and business, end quote. And this was also something at Amazon that Andy Jassy had telegraphed in June. The Amazon employees knew probably that this type of stuff was coming when he said, we will need fewer people doing some of the jobs that are being done today and more people doing other types of jobs, which is code for we're going to cut and then rebuild, I think, Malcolm.
Well, that's the case that I've been making for some time. AI is not coming for your job specifically. The company is not saying you no longer have a job here because this software is going to take over your job. The company is saying we don't have any idea what butts and what seats actually make sense in a post AI integration. And so the logical answer here is to figure out what butts need to be in what seats working alongside robots. So anybody we're confident that we'll be able to hire you back at some future point, maybe even at a lower price, that's who we're going to cut today. And then anyone else that we want to try and figure out how we're going to rework you into a different seat next to a robot. And I'm saying next to, like, for, you know, but not literally, like, but we really want you focused on the thing that you are best at, and everything else we can leave to the software. That is the mantra within the top tiers of these tech companies. And I think we just got done talking about, or I just got done talking about how awesome and important Nvidia is, right? Nvidia is the poster child, if you will, for efficiency. They've got 80% gross margins in their best quarters. They have $3.7 million of revenue per full-time employee on their payroll. That is a massive productivity number. The next closest company to them is Apple at 2.4 million, and then Meta at 2.2. So just consider how a company like Amazon, who's not even anywhere close to that number, it's hard to rank it because Amazon has about 350,000 corporate employees, and then like another million that work in warehouses and everywhere else. And so I don't really know what that number is, but like for Microsoft, for example, gigantic behemoth of a company does a gazillion dollars in revenue, 1.1 million revenue per full-time employee. That's before this recent round of 10,000 people they just let go. But still, like, that number is nowhere close to $3.7 million of revenue per full-time employee. And that is what everybody in this industry is chasing.
Do you know who smokes all of them? I'll give you a hint. They have 42 full-time employees, but significantly more contractors worldwide.
Uber.
OnlyFans has $38 million per full-time employee. So you gave me.
I never would have guessed that was the direction you were going to take me.
Apple, and this is a graph I have found on Reddit and also from other sources. OnlyFans, a private company. You've got Meta 2.2, Apple 2.4, Nvidia, which you were just bragging about, at about 3.6. OnlyFans 10x Nvidia revenue per full-time employee at about $37.6 million. It turns out that being horny is a better business than designing chips. Malcolm,
I'm curious, based on that math, though, what would YouTube's numbers look like if it was a standalone company? So if YouTube, because you're talking about basically the creator economy, they're calling them contractors, but basically like you do the work, we get a take. That's why I assumed you meant Uber. But I wonder what YouTube would look like, since 100% of the content on there basically is user generated. What are their per head numbers look like?
You have a lot of clients in the tech world, and I'm sure they're thinking about this wave of layoffs right now, thinking in a different way. And I had to do this recently, not just how do I save for retirement, but I might have an extended period of unemployment.
Yeah, well, so two things. One, I want to go in a completely different direction, and I know you probably thought I was going to.
That's fine.
Giving the traditional, like, how an emergency fund works and all those different components that any and everybody who writes about personal finance throws out there ad nauseum. Yeah. But one other thing that I think is really important that's a little bit non-conventional is the fact that you can take pauses in saving. You can take pauses in putting money away for retirement, for your kids' education, all those kind of things, and still be fine. Like, you can still actually turn around and meet those goals by having to take a 6 or 12 month break, get your finances completely lean so that you can make it across that void, and then get back to being diligent about saving. Like, I've seen people who were terrible about saving until they got to about 50, still spend a decade being super aggressive savers and be on track to hit their retirement number by the time they hit 62. So, because, you know, based on the way math works and the way money works, like, you could actually save $1 million and double it in 10 years. Like, that is functionally possible. So, not to necessarily try and go in that extreme direction, but I think it's important for people to know that, like, taking 6 months, 12 months, you got to hit the pause button on your 401k contributions, got to hit the pause button on your emergency reserves, got to actually tap into your emergency reserves because you were saving for a rainy day and now all of a sudden it's raining outside. Like, forget the tech layoffs component of this for a second, just thinking about government workers who haven't had a paycheck in a month. Like, folks that I know personally who have emergency savings are like distraught by the fact that they actually have to use their emergency savings because they've been laid off. And I'm like, you were saving for a rainy day and now it's raining.
Mm-hmm.
Are you going to walk out without your umbrella and say, like, I don't want to put my umbrella up, so I'm just going to walk in the rain? No,
Well,
you were buying an umbrella in case it rained.
yeah, but you're reversing the thing that you're good at. So if you're good at saving, there is a sort of, there's a behavior that is your patterned behavior is I am good at saving and I'm doing the thing I'm good at. And once you're using those, emergency funds or rainy day funds, it's a behavior reversal. And even though it's logically true that this is what that's for, it's still intensely difficult.
That's a good point. Super savers see it as an identity.
Yeah.
You as a saver become like enthralled with the idea of, I save 20% of every paycheck that comes into my house, and that's what I do. That's who I am.
And a few things on that too, because I didn't get laid off, but I did leave a job, and I was in the wilderness for a little bit. Now I'm starting to figure out what I want a little bit more and thinking more in terms of like that advanced education stuff where I've basically stopped saving in retirement funds, but I'm thinking, I'm investing in I'm doing things that I'm investing in growing my potential future income in a meaningful way. That amount of like spending time on that also is a form of saving. And that's a way I've kind of had to rewire my brain on it.
I recently published a book where I mentioned something along those lines, the idea of investing in yourself and in your future earnings being more valuable than putting those dollars into the stock market. But I won't get too far off onto that tangent, because the other piece that I wanted to tie in is the unconventional side of this that I wanted to really focus on, is that in some instances, having a layoff, having a temporary stoppage in income can actually be a benefit to you from a financial planning perspective. So from a tax perspective first, consider the fact that this is typically advice that I would give when advising a couple and one of them decides they're going to go back to school. And so if you think about a couple that makes, $400,000 in gross household income, 200 on one side, 200 on the other, that puts them in the 35% marginal tax bracket. You eliminate that income on one side, and that immediately puts them in a 24% tax bracket. Gross income, I'm talking. Federal marginal tax bracket, I'm talking. So now 11% income tax has disappeared next year. A grad school program is going to be 2 or 3 years. So for the next 2 or 3 years, your income's artificially low. Well, you know what? That just created an opportunity to do Roth conversions in each of those years that your income is artificially low, back up to the point that you were used to paying your income taxes at. So I got $400,000 basically in pre-tax savings that I could convert in those 2 years, bump back up to 400,000 where we were, not really miss a step from an income tax perspective, but down the road, my future self is going to have $400,000 plus whatever earnings on top of that, tax-free, that we get to tap into as retired people. And with so many people talking about wanting to retire earlier than the government tells you you're allowed to, your 50 or 55 or 60-year-old self will thank you for having a tax-free pool of funds you can tap into before you hit your Social Security age, your RMD age, all those things, if they still exist the way that they do today by the time we get there.
Well, I can tell you a lot of people are not thinking about that, because when you leave a job, your next thought is immediately, how do you get these like, fight, flight, resource, deeply human resource instincts where you're like, what do I do next to secure food, even if you have a good amount of savings? And I think what you just highlighted is why it's good to, a lot of people when they change jobs, especially when they're younger, they're not talking to a financial advisor, and it's probably a good idea. And it's also, a lot of financial advisors market to people who are saving for retirement, close to retirement, but this is the time that people actually really need some financial planning guidance. And one of the things that really hit me when I left my job is the lesson is I became a much better budgeter. And the thing that I really learned is it's a lot like working out, in that it's unsustainable if you immediately go to a, Biggest Loser style, extraordinarily strict, intense way of doing it.
Yep.
And it was for me, it was figuring out how to build in some grace for myself while also being disciplined. And what do I mean by that? Like, my wife and I, we delayed, hopefully not cut, but we delayed a trip to Japan that we were really working on. There's some immediate costs that you can immediately bring down and you'll feel more secure. We cut going to, like, we still sometimes went out to eat, but that went down a lot. And when we went out to eat, it was usually somewhere that was significantly less expensive. If friends wanted to get dinner, we're saying yes to that. And then for me, it was ticketed events. So I love going to concerts, movies, sporting events, and that's where I spend a lot of disposable income if I can. And for me, it was cutting basically all of those except movies, because I have a subscription movie pass. I know myself, I got to get out of the house and find some entertainment. You can't just lock yourself up in wherever you are. You have to find ways to get out and enjoy life. And for me, I love going to the movies, but it was finding a way to do that in a lower cost, more disciplined way.
You didn't know this, but that was actually one of my other unconventional things.
Go ahead.
Is that you can't sit around doing nothing and thinking about doing nothing and like stewing in the place. And so finding a low cost thing you can do that eats up a lot of time throughout the day, like applying for jobs and interviewing for jobs is a part-time job all by itself if you're doing it right. But then with the other 4, 6, 8, 10, 12 hours that you have throughout the day, like sitting and watching 2 movies is a great way, and not in your house, sitting and watching 2 movies at the theater, a thing you have to put on clothes and take a shower and get out the house and go to in a very cheap way is a great idea. Like I could throw getting a gym membership and going to the gym, but like a lot of times, like when you recommend things like that, if you're not already a person who goes to the gym, that's not interesting to you. Like you're not going to suddenly develop a long distance running habit just because this bad thing has happened in your life, right? So, but anybody can sit in a movie theater. Like that doesn't take a lot of physical exertion. And so like those kinds of things that are very low cost are a great way to help take your mind off of it and refocus you elsewhere just for a couple hours every day so that you can get back to trying to figure out where your next gig is going to come from.
And the other thing that does is it creates some discipline, because if you're planning it in advance, I know I'm going to a movie tonight at 6:00. What's that mean? I got to figure out my meals. I got to make sure that I get all of my job hunting done in a certain amount of time if I want to go to the gym. Because one of the things that can become easy is if you're used to, like, I was used to working on a show that came out 6 days a week. Your schedule is packed. And with meetings, with projects that have very certain deadlines, and immediately when those disappear, it's easy to sort of sink into like, well, shoot, what do I do next?
Yeah.
And I actually think building, planning for your mental health when leaving a job is just as important as probably planning financially. And I think that's why, those plans that even may be wrong on paper in some respects, where it's like, oh, you shouldn't spend money on going to the movies because you need to save, are actually the right decision. The one that was a mistake for me when I was the few months after I left my job is I was like, I need to make coffee at home because I need to save. I don't want to go to a coffee shop and spend, those $6-7 coffees can add up so quickly, or lattes. You can get coffee cheaper, but I like a latte. So those can add up so quickly, and then you're spending hundreds of dollars before you know it. But I work better when I'm around people. So it's really like, I needed to reframe that as an investment. I know that I can feel refreshed and get more done by being in those places where there's sort of those soft social interactions. And even though I'm like, I need to budget and get really disciplined, it was the wrong decision for me, even though that costs some money to go to a coffee shop on a Tuesday at 9 a.m. and get some things done.
So 2 other things I'll throw in there that are a little bit off the beaten path, if you will. A lot of our firm's clients are people who get paid in equity as part of their total compensation plan. And a lot of times people tend to think of the shares of stock that they own in the company that they work or worked for as this own separate bucket of cash, or this own separate bucket of paper money. And what I've seen is when people leave a gig, their tendency is to just cash out all of the stock that they own entirely. And that's now their emergency money that they're going to live off of. But I think a safer, smarter approach instead, especially for people who have a huge gain in those shares that they're cashing out, is to instead go to your broker and ask them for a line of credit against those shares. So you can do a securities backed line with a Fidelity or a Schwab or whoever at E-Trade, whoever manages your company's stock plan, and they'll charge you 7-8% interest, the same you'd pay on a really great credit card, except the difference is it's levered to the shares that you own. This keeps you from having to pay that 20% long-term cap gains tax, but then also gives you the ability to pay off the interest that you accrue on that line at some future point. So you could keep your shares intact, sell a few if you needed to pay off the line, but you've got tremendous flexibility that allows you to make that decision later on down the road from a place of strength rather than a knee-jerk reaction, which is just sell and figure it out later, which is not necessarily where you want to be making that kind of a decision.
Is there any risk to doing that, where if you're taking a loan against those shares, what happens if those shares go down? If you have a Meta in 2022 or 2023 moment where, you've taken a loan out against the shares, the stock goes down 40-50%, what's that mean for the person who took out that loan?
So that's actually why the companies don't allow you to borrow more than 70% typically on a stock portfolio that's diversified. If it's a concentrated position, saying I'm a Meta employee, all the stock is at Meta specifically.
Yeah.
I think that number gets capped at about 60% depending on the brokerage. So they have those mechanisms in place to guard themselves around having to call your capital, have you have a capital call in those moments. And so you can only borrow up to that point. But I'm glad you brought that up, because you'll have to take out a line of a certain size. In many cases, they'll say like 70,000 is our minimum, line size, 100,000, whatever it is. But you don't have to use that whole thing, right? It's really just meant to be there so that you don't miss a mortgage payment, or so that you don't actually miss, whatever the thing is you normally would be doing, especially for single people who don't have a second income in the house to help make this planning work with. That's just one more place that you could go to for capital so that you're not having to make those really terrible decisions on A versus B. But that reminds me of a second thing that I was going to say, which is to be proactive and immediately call any creditors that you have that might be sympathetic to your situation, your mortgage company. Hey, listen, I just got laid off. I just got furloughed, whatever. Can you pause my mortgage until, 6 months from now? Can you pause my credit card payments until 6 months from now? Can you pause my student loan payments until 6 months from now? And in many cases, those companies will say yes, as long as you have that loan through some reputable company that has the ability to check. And they probably already have an internal notice that says, if somebody calls with this particular set of issues, go ahead and grant them 3 months, 6 months, 12 months, whatever that number actually is. But you can't wait until it's been 4 months and now you're running out of cash to suddenly decide to make this call. You got to make that call at the onset, so that, again, this is happening from a position of strength and not a knee-jerk reaction in a moment of crisis.
That's great advice. And I got to wrap up. But one thing I've also done that's helped me is sort of organizing my money in 3, 6, 12-month buckets. And I have money that I immediately need, maybe for the next 3 months, that's invested, like not even invested, it's in a bank account. Then you have 6-month money, which is, government securities. I have a little high yield bonds in there, which wouldn't be recommended, but I'm okay with that risk. And then, still that 12-month out money. And while the returns, especially from that like money I may need in 6 months, is not super material, honestly, if I need it in 6 months, for me, that's been a useful exercise in sort of monitoring my financial oxygen tank, right? Like, where am I at in terms of, layoff? How close am I to like taking a job that I don't really want, but I need to do it just for cash? And I think that that's been a useful thing for me. Anything else you want to chat about with this before we wrap up, Malcolm?
Yeah, my last piece of info or intel on this is just that the Roth IRA functions something like a savings, a long-term savings account on steroids, in the sense that your initial principal, whatever you've contributed into that Roth IRA, could also be viewed as your emergency reserves. You can pull out the cash that you put in there initially at any point without having to pay taxes on it. It's the growth in it that you have to worry about the 59.5 rule and anything else on. And so just be aware that for those who have built up a substantial balance in a Roth IRA, you've been diligent about making contributions into a Roth IRA, you may want to look at what your basis in that is as the ability to pull capital out to act as that emergency reserve if you don't already have it or you've already burned through what your emergency reserves were.
Great advice. All right, let's leave it there. Oh, if you like the show, make sure you rate it on Apple Podcasts, leaving a couple sentences, and then hitting submit for that rating really helps the show. You can find me at Rick So Slick on X, Ricky Mulvey on LinkedIn, Malcolm on Money if you want to keep up with what we're doing. Appreciate you listening.
Information shared in this recording and by its guests represent the views and opinions of the guests and does not represent the views or opinions of the host. This content has been made available for informational and educational purposes only. This content is not, nor is it intended to be a substitute for professional financial advice. It is always recommended that you seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your personal financial situation.